Yep. Okay, thank you so much for taking time out to join us this afternoon. So once again, the webinar is called How to Access International Funding for Your Nigerian Business. Now, why the webinar? So Africa's population is expected to rise to 2.5 billion by 2050. And this population is largely comprised of young people under the ages of 40 years old. This same population lives and breeds technology. Virtually everything we do today is driven by technology in Nigeria. The Nigerian tech industry, and precisely, through the Nairametrics, startups operating across several sectors in Nigeria raised an estimated $248.6 million in 2021, an equivalent of 102.77 billion naira by the third quarter of 2021. Another source online also said that despite government regulation and crackdown, Nigeria's tech sector has seen enormous gains in 2021, raising $2.9 billion, across, different sectors. This is inclusive, I beg your pardon, this is inclusive of other African countries, not just Nigeria. Nigeria raised 60% of that amount. So, and just yesterday, I read in the news that WEAV is now valued at $3 billion. Having said that, there are tons of opportunities existing in Nigeria around consumption, household consumption, and business-to-business consumption. This may be relevant, and from the McKinsey Global Initiative's Lion on the Move report, which was released many years ago, there were projections that by 2025, household consumption will be about $2.1 trillion, while business-to-business spending will rise or increase to $3.5 trillion by 2025. We're in 2022, which means that in 3 years from now, all these figures will be a reality. Having said that, this is the reason why we've organized this session to explore how to access international funding for your Nigerian businesses. You all know how difficult it is to access credit or to access investment, loan facilities, whether debt, whether equity. Investment is, accessing investment is not an easy thing to come by. But a lot of us a couple of Nigerians have, done well and have, found their way around it and have been able to successfully raise this funding. And to this end, we have invited the selected few to share with us their experience in raising international financing for business. So having said that, I will go ahead and introduce our guest speakers for today. Ladies and gentlemen, I'd like to introduce Amaka Okechukwu Okpara. She's the founding partner, Women's Enterprise Acceleration Vehicle, which is WEAV Capital. Amaka is an investment professional with over 15 years of experience in the private sector and international development. She's the founding partner at WEAV Capital, an early stage venture capitalist firm dedicated to funding and supporting the most innovative female founders across Africa. She previously worked at the World Bank on private sector development, directly managing a portfolio of $1.1 billion in projects across sub-Saharan Africa. She has extensive experience in working with entrepreneurs and in setting up investment vehicles. She oversaw a $2 million grant facility for renewable energy companies and funded and provided technical assistance to several business incubators and venture capital firms in sub-Saharan Africa. Prior to the World Bank, she worked with several organizations, including the United Nations Foundation, the Brookings Institute, and the Center for Global Development, where she worked on financial inclusion, regulation, and access in Latin America and Asia Pacific. She started her career as an investment banker in London at Deutsche Bank, structuring debt and equity financing for European hedge funds. Amaka is a fellow. Amaka is a fellow with Arambe Entrepreneur Alliance and was a global shaper with World Economic Forum. In 2015, she was selected by the WEAV to participate at the World Economic Forum in Davos, Switzerland. She sits on the board of several companies and served as the World Bank representative on the board of the Development Bank of Nigeria. She holds a bachelor's degree in economics from London School of Economics and a master's of art in public policy from Johns Hopkins University. Ladies and gentlemen, let's welcome Amaka Okechukwu Okpara. Amaka, welcome.
Thank you very much, Heidi. Thank you.
Sure. We also have here Mr. Gatumi Aliyu. He's a co-founder and chief operating officer at Vendease. Gatumi is a two-time Y Combinator founder with over 9 years experience leading, managing, and working in teams in supply chain, agri-tech, health, and technology. His passion for leveraging technology to improve lives has led him to work in supply chain, healthcare, technology, and investment banking to better understand how to build better companies with greater impact. Gatumi is currently the co-founder and chief product officer at Vendease, a Y Combinator funded B2B marketplace. Gatumi also co-founded 54 Gene, another Y Combinator funded African genomics company. Gatumi holds a first degree in biology and chemistry from the University of Pittsburgh, and then on to medical school at the University of Medicine and Health Sciences, leaving after 3 years to pursue healthcare with the potential for large-scale impact. Gatumi, welcome.
Thank you so much, Heidi. Just a quick disclaimer: I am on the road in London, so my network, I'm hoping that it will hold up today. But it's a pleasure being here.
Okay, fantastic. Thank you. Our third speaker is Mr. Femi Oye. I hope he's in here. He's the CEO of 1 Watt Solar. Mr. Femi Oye is a clean tech investor with more than 20 years of social entrepreneurship. He committed to leveraging local innovation, financial engineering, partnerships, models to rapidly scale up high impact solution for 1 billion people. Wow. Mr. Oye is a crazy thinker. Those are not my words. Unreasonable optimist, social investor, life coach, chief architect, and African innovation leader. He is a keynote and conference speaker, a United Nations observer, and a technology committee co-chair. Mr. Oye is an alumni of the Harvard Business School, Santa Clara University, and Stanford University. He's also, it says he's an MIP, that's Politecnico di Milano, obviously that's Italian, and a doctor of business from Swiss School of Business and Management, Geneva. Mr. Oye, you're welcome. Hello, Mr. Oye. I'm not sure Mr. Oye is in here. Hopefully he will join us soon. Okay, so I guess we'll kickstart with a poll. May I crave your indulgence to quickly help us respond to this poll before we get started? So I'm going to launch the poll now, and please feel free to participate. Okay, I believe everyone voted. I think everyone has voted already. So, okay, I think we'll just go ahead and end the poll now because of our time. Okay. Some people are still voting. Are we all done voting? I can just get a thumbs up. That would be great. And just get a thumbs up. Okay. So I'm going to hand the poll now. Thank you so much for participating. So I'm handing it now and sharing the result. Cool. I'm sharing the result now. Thank you so much for participating in the poll. So I think we'll just go ahead and we'll get started on with, in engaging our speakers. So let's kickstart with Amaka. Amaka, welcome once again. I wanted to, first of all, get a sense of your story as a fundraiser, or as a, I'll say as a fundraiser, or an investment person. Could you share your story in terms of your experience raising funds, financing for businesses?
Absolutely. So thanks, Kyrie, and thank you all for having me. Happy to be here, and I look forward to the Q&A and really getting into the weeds of some of the funding questions anyone might have. But my name is Amaka Okechukwu, Okpara. I think you have the introduction, but effectively I've funded several businesses in different ways, right? So I've done grant funding, which has a totally different approach. Also done debt funding, which again, slightly different approach, and venture capital funding, / equity funding, and that's also a very different approach. So, I've worked with several companies to raise either of those types of funding vehicles, right? And it's always different, right? So the needs of the companies that pick up grants, debt, or venture capital are quite different. And the sorts of investors that are attracted to different types of instruments are also very different. So, it'd be great to get a sense of what types of funding people are interested in. And I'm happy to share during the course of the conversation, the types of companies that I think are better fits for different types of funding vehicles, and what sort of things you need to do to sort of position yourself with the different types of funding. But overall, my background is in funding and supporting businesses, both with funding and also, operational support, which is why, you sit on the boards of several companies to help them to scale up, to think through their business model, and how to improve that. Another thing that's also very important, I think, when you're raising debt, is to think through your governance structure. And I'm sure we can go into the weeds of that, because truly the governance is really the determining factor for companies that are able to successfully raise funds and those that are not. So we can go into the weeds of everything, but in a quick introduction, this is what I've done, and I look forward to working with all of you and answering any questions you might have. Thank you.
Thank you so much, Amaka. That was brief, concise, call it whatever you want to call it, but very concise. Thank you so much. Gatumi, we would really, really love to hear your own story about how you've become a guru at taking businesses to Y Combinator.
Kaidi is always so generous with his introductions. So hi everybody. I'm really, really happy to be here. I'm very passionate about sharing tools to raise capital, like I've done in the past. So my name is Gatumi Aliyu. I currently I'm a co-founder and the chief product officer of Vendease. Prior to this, 2 years ago, I also was a co-founder of 54 Gene. So combined, both of these companies have raised over $25 million in equity capital for each business respectively. I would consider myself very good at raising equity. I have never raised debt. So I'm also here to learn how to do that as well. But yes, I'm here to do that. So my story, so I went to undergrad in the US, University of Pittsburgh, studied biology and chemistry. After that, I went to medical school. And in my third year of medical school, I realized that as a doctor, no offense to doctors, I wasn't going to make that much money. And I figured, it was a bit of a tech revolution going on. So I figured, there's a way there has to be a way for tech to disrupt medicine. And I moved back to Nigeria, worked in investment banking for a little bit, and the opportunity to start 54 Gene came about. So we did that, went through Y Combinator, raised capital, and got kind of successful with that. And seeing that process and seeing all the other problems that was in Nigeria, I figured if I could do that with that, I hopefully could do it again. So I started Vendease. Vendease essentially allows hotels and restaurants buy directly from farmers and food manufacturers, and provides credit so that they can buy now and pay later. Started Vendease, went to Y Combinator as well, and was also able to raise capital. And fun fact, we're actually also fundraising now, so this is a good time to talk. So yeah, in a nutshell, that's me and my journey so far.
Thank you so much. Thank you for sharing that. Now, Mr. Oye is still, I think he's stuck in transit, so he'll be joining us shortly. So I wanted to let's get into the meat of the matter. So one of the first few questions that I wanted to quickly bring up is the question of so help us to understand, and this question is directed to Amaka. Amaka, help us to understand the business model behind venture capitalist structure.
Okay, so I'll do that. So in a quick summary, venture capital investors typically would put some sort of equity or quasi-equity investment into companies, but typically to be equity, right? Either it's a debt that will convert to equity, but effectively it's pretty much an equity investment in your company. So they are partners and shareholders of the company, and they make money only when you make money, right? So that's typically what a venture capital would do. So how they make money is obviously when you grow as a company. They would typically come to you at earlier stages than most banks would want to touch you. So, startups, a year in, 2 years in, 3 years in, I'm sure Gatumi can even share the experience with 54 Genes and Vendease, but typically less than 3 years. These companies are very young companies. You would get in early. So depending on the stage at which you're comfortable as a venture capital fund, some venture capital funds will invest at the pre-seed stage. So this is when you're just starting off, and perhaps you've done a proof of concept, and they would come in and sort of work with you to scale. They could come in at a seed stage where you've earned some level of revenue, but not a ton. And then again, they would put in some money. They could come at a Series A. So this is when you're a more established company, and you're already scaling and you're looking to scale up even faster. So venture capital funds can operate at different stages of your business. You even have late stage venture capital funds that could come in at Series Bs and Cs. So these are companies that are scaling up massively and going into several countries and things like that. So as a venture capital fund, you're looking to invest in companies that are audacious, right? So you're looking for companies that are very, very high growth companies. Because of the stage at which you're investing, it's very risky. So it's not as risky, it's not like debt funding or, typically it's very risky investment, right? And you're coming in very early. So typically you would want companies that are really growing very fast or are looking to grow very fast. So that's why and also companies, so these are what we call high growth companies, right? So when I say very fast, I think it's very important to quantify that. What is seen as good growth is in the very early stages, like 3x, right? So year on year, you're growing your revenue by at least 3 times, year on year in very early stages. And even more, right? So I think it's we talked about Flutterwave, and Flutterwave, I mean, it's good to see that 6 years ago there was no Flutterwave, and today you have a $3 billion company, right? So that's the sort of growth that a venture capital fund is looking for. Now, not every company will become a unicorn, which is a company that is valued at 1 billion or over. But effectively, what a venture capital fund is looking to do is to get these high growth companies that are looking to scale massively, who are looking to be billion-dollar companies, right? And of course, because of the high risk model, and because of the stage at which you're investing, you are very comfortable. You have to be comfortable with risk and failure, right? So a lot of your portfolio companies will actually probably not do well, but the ones that do well will do really, really well. And so that's why really venture capital funds make money when they invest in businesses and those businesses thrive. So most VCs are not, what they look for is companies that are very, very audacious, right? So you have to be looking to solve a very big problem and to solve it efficiently, and you're looking to massively scale, right? So not all businesses are venture capital businesses. And I think that's something very important to see. And it doesn't mean that if your company is not a venture capital company, it doesn't mean that it's a bad business. It just means that, typical venture capital fund might not be, it might not fit into their business model, right? So not every company wants to grow, 3 times, year on year, or generate, or become $1 billion company. And that doesn't mean the company is a bad company. It just typically means that most venture capital funds might not be as interested. So in a nutshell, a venture capital fund takes an equity stake in your business and grows with you. So typically a VC, and we can go into, some VCs are hands-off, so they just invest and they leave you to it. Some VCs are more, hands-on, and they help you to raise additional funding. So at WEAV Capital, we're very much co-builders, right? So we invest, we would work with you to build your company, on your operations, on your strategy, and on raising your follow-on rounds, right? So to make sure that you're well capitalized. And of course, as you grow and as you make more money, our equity stake, keeps increasing in value. And of course, we wait for some liquidity event, which is when either you're bought off by a strategic company. So we had, obviously, like we had the Paystack Stripe, for example, here, where Paystack is bought by a bigger company, and that's fantastic, right? So if you're an investor in Paystack, you sort of get your money back, and you've made tons more than you put in. So that's how VC would make money typically. So in a nutshell, I hope I've answered that question.
Right, I believe so too. Thank you so much, Amaka. I believe Mr. Femi Oye is in the room. Am I correct?
Yes, apology for coming late. Good day, everyone.
Yes, good afternoon. Thank you so much for joining us. I'll come back to you shortly. Gatumi, can you speak to your own sense of the structure of the business model of a venture capitalist, and also what businesses in Nigeria should be looking out for when they are looking for an investor?
Oh, okay. Thanks, Heidi. So a lot of the things that Amaka has said has been absolutely spot on. Everything she said has been spot on. So I'll try not to overlap and try and just talk a little bit about maybe from the entrepreneur side. So like she said as well, a VC essentially gives you money for equity, and they typically come in at different stages, right? Some people make a distinction and will say angel investors come in really early at the pre-seed or even sometimes earlier, and then a VC will typically come in from a seed to a Series A, etc. So the difference between an angel investor and a VC is just, an angel is usually like an individual, somebody who's giving you their own cash, versus a VC being more institutionalized. So a group of people under an umbrella giving that money. So in terms of what you should look out for from a VC, one, I would say look out for people who have money. So I'm going to talk very, very, very brutally honest as an entrepreneur, right? Look out for people who have money. Sometimes people want to give you money for a lot of your equity. especially if you're very early on. That's not a good idea, because if someone's giving you, for example, $100,000 for 30% of your company, I would say don't do that. So people also, the value of capital to the VC means a lot, right? So if you're talking to, for example, Tiger Global, who have billions of dollars under assets under management, they're likely to give you $100,000 for a lot less and allow you to grow your business and still retain the significant amount, right? You're the one working really hard. So that's one. But two, but more than that, right? Also work with somebody who understands your market and your terrain. So yes, a Tiger might give you a lot of money, but they may never speak to you until your next round. So you also, did you say that again? You also want to talk to somebody who understands your market, also has invested in similar companies like yours, obviously in other markets. So for example, imagine you were a Paystack, right? You could talk to the investor that invested in Stripe, right? Because you're doing a similar business. If you're a Vendease, you might want to talk to a company that like Ninja Cart or Rappi, who's done that in different markets globally. And then finally, just understand the VC. Make sure that all your values align. I know sometimes we want capital a lot, and we forget to make sure that our general values align with who's giving us this capital, right? Because sometimes when they give you money, they also come on your board. So you want to make sure that the person that's having this sort of control is aligned with you in terms of how you think, how you want to grow, etc. That's one end. But in terms of like getting ready for VC money, I don't know, Kaidi, did you ask, was that part of your question as well?
Yes, please.
Okay. In getting ready for VC money, I would say the number one rule is traction. I joke with people that I talk to a lot, and I tell them that the only difference between an SME and a startup, other than technology, is growth. Our rule is grow or die. I heard, I think Amaka said, I think she said 3%, or was it 5%? I can't remember the percentage.
3 times growth, yeah. Right,
3x, sorry, not percent, 3x. So we grow 7% week on week. And that typically in a year turns out to be about, last year for us, it was 20x. So growth is everything, right? Especially at the very early stage. When you're getting later on, 3x is a lot because, but at the very early stage, you want to target 20x, grow or die. What are you doing if not growing, right? And the more you grow, the more you have more people interested in funding your business. What you don't want is, you don't want a situation where you're at the mercy of somebody giving you money. Then they typically shortchange you. But by the time you're really growing fast, this is the trick about VC. People have money and they don't want to give it to the bank because the bank is going to give them a very short, very small percentage back in a year. So those people are looking for riskier investments with the potential for more reward. And all you're trying to do in the entire process is to, one, tell them that this is a better investment, right? Higher risk, but a lot higher reward potentially. Two, you're trying to de-risk that decision for them. So you're already working in Africa, which is risky. So now you have to de-risk it by saying, look, we're really good. Our customers, people want to use our product. We're growing 20x every year. You're more likely to get VC investment. I hope I've been able to kind of touch on that, Kaidi.
Absolutely.
To add to something.
Okay, please. Then after that, I'll go to Mr. Oye. Yes, go on.
Okay, yes. I really just wanted to underscore that point you said about understanding and knowing who you're getting into bed with. Like, truly, sometimes it's easy to say, I just take any money I have, but it's truly very important to see that alignment. And it's usually can mean that businesses actually fail. I'll give examples, just 2 quick examples. One, at the angel stage, when you're taking angel investment, make sure the angel actually understands the business model. I've seen angel investors that have put in money in a business and get pissed off. 2 years later, when you're trying to raise a seed round, they're like, don't dilute my equity, right? And and basically business comes to a standstill, right? I've seen some businesses that had to actually shut down because of that. Also, even that alignment of values and where you're growing the business, where we want to be. Because if you don't have that alignment, you just have fights in the boardroom where you're trying to pull the company in different directions. And I've seen, VCs, depending on how you negotiate, right? Like, you want to be very careful that, you're not kicked out as a founder. I mean, it's very possible that could happen, right? So make sure that there's full alignment with whoever you're getting into bed with, like any funder you're getting into bed with. And the third thing I'll say to that is also make sure you get a venture capital fund that can add some level of value, right? So, and this is now you being picky, right? So now once you've gotten your values aligned, try and see that there's something extra, right? So whether it's a venture builder that, as you said, knows your business and is able to connect you to the right people, one that's thoughtful and can even be like a thought partner that can help you with thinking. So just don't have like dead equity. Like, don't have someone that is sitting on your cap table and is not really adding any value if you can get to that point, right? And I think, if you grow really fast, as Gatumi said, right, if you have that traction, you will see a lot of venture capital funds wanting to participate. And I think then you can actually become a bit more careful about who you select as a partner, as a venture partner. Thank you.
Thank you, Amaka. Thank you so much. Thank you so much. Mr. Femi, thank you once again for joining, and I'm sorry you had to go through a lot, joining, but eventually you made it here. Mr. Oye, could you tell us just speak to your own investment story? How you've raised, what you've raised. I mean, just a sense of what you've raised. It's not like we're asking you to give the audience your CV, but in terms of what you've learned through the process and what should businesses in Nigeria be looking at in terms of preparation for fundraising.
Okay, thank you so much. And thank you, Amaka, for the thought you've given. And also, is it Mr. Aliyu, right?
Yes, Mr. Aliyu.
Yeah, thank you so much. I also love those very deep contributions that you've made. So my background, basically, we are an early stage, also as you call it, catalytic kind of private equity firm, and also we use a lot of social capital. So it's a kind of blend between the common VC or the family or the type of different levels of financings that you have on the table. So we bridge that largely. And as an entrepreneur also, I build startups, I build businesses. So I talk more as an entrepreneur. However, we started SMEFUNDS because we saw the gap and understanding the local dynamics in Nigeria and how difficult and challenging it is for very high risk startups, especially when you're trying to try out new ideas, new concepts. So there's probably no funds on the table for such. Grant is, at that time, about 20 years ago, was probably non-existent, except in the non-profit NGO sector where you have grants to do some of the things that you have to do. And we also have the other side of grant that we call technical funds, technical support, which I also encourage entrepreneurs to go for today. So technical support used to be for non-profit and to try out proof of concept and to bring new products to the market. We've used a lot of these. I've used over $10 million in terms of technical support from local bank in Nigeria, where they ordinarily don't provide that, to CBN, to Bank of Industry, to African Development Banks, to Deutsche Bank. All these organizations at the end layer of the funds, either equity or debt that they will be providing to your business. You also want to be sure that you are able to get a pinch of a technical grant that could go into maybe for your legal, for developing your team, or building the HR or the management pack, or even testing the market, marketing processes, designs, and also in terms of hiring. So you want to get some funds that cannot immediately begin to turn in revenue or profit into your business. So as an investor, it's your role to fall in love, not just with the returns that you want to get from a particular enterprise. You also want to buy into the vision. So as entrepreneur, you want to look for those alignment between who is going to be funding your business and where your business or where your vision is taking you to. Because at the end of the day, you are the most important critical factor on the table that has to be considered when we are talking about raising funds or scaling businesses. So there are different types of funds that, of course, you can use at the early stage of your business. So we talk about startups today in the tech space, where we talk about investors asking for 20x, 50x, 30x. And of course, after COVID, we've seen some of the returns coming down. I mean, expectations of investors coming down now. I think typically it's the one that used to be 10 has come down to about 4 now. And then we have new deep tech in terms of the clean technology. And when you're running business in the climate space, so that is even going up. About 3 years ago, it used to be about 11x. So when I got in Acumen Fund into our biofuel company, that was in 2014, 2015. So we sold to them at exit of 20, our valuation was 20x. So they're going to exit at about 3.5 above that. So today now, 20x in clean technology has become about 35 because it has become more valuable. And with the new laws and the new programs launched by developed countries and are the outcome of the COP26. So you now see most investors or most funds now asking those people managing these funds to begin to look for businesses that also align with the triple bottom line, that is people, planet, and profit. So you want to ensure that you have all these components built into your business because it goes a long way to help you negotiate a better deal. And in the area of the technical side of African Development Bank, as an example, we got about $1 million into building a plant. These were ordinary funds that would have gone out to raise debt to provide those technical support programs that the business needed to even get the business plan on the table to be able to pitch or talk to serious investors. So when you get a term sheet, it might take you another 1 year before you can even fulfill some of those things that is written in the term sheet. So that's why it's an indicative offer, but before you eventually draw down, so they're going to give you some milestones that you have to achieve and attain. So that's where technical support comes in. So the third component, apart from the equity that you need to look for investors that align with your vision, the third part has to do with the entrepreneur itself, where when you are starting. So you are starting with your home funds, with friends funds, with family funds, people that believe in you, that believe in your vision, that believe in where you're going. And at that level, you probably have no valuation, right? So you want to probably go for the one that YC instituted, which is the, is it called SAFE now or SAFT? So you want to use that to quickly get some early investors that could put a bet on the idea, on the business that you have. Most of the time, out of every 10 investment of SAFE that we do, is probably 1 or 2 that survive after 3 years. So that is the price that investors have to play to be able to get the golden egg. But at the end of the day, you found out that most VC firms, they are more interested in mid or later stage investment. When you've already proven all the test cases, you already post revenue, and you are now ready to hit the ground running. And like Mr. Aliyu talks about, growing 7x every week. I'm interested in that. That is crazy. So that is very ambitious, right? And when you want to give a promise to an investors coming in, because at some point they need to exit at a higher valuation. So that is why you see companies doing Series A, B, C, D, E, and F. So those subsequent funds, it's not really that 100% of those funds goes into growth. It only goes into exiting the early investors that have already come in. And of course, it's an ideal model because at the end of the day, you want to grow and drive value for shareholders because that is the exact goal of business, not for you to fall in love with it. It's for you to build and sell at some point in time. So you continue to dilute it because a business must be bigger than you. That is the whole idea. And you need funds. So you don't need money to start a business, but you need money to be able to scale any business. So let me just pause there. Thank you.
Thank you, Mr. Oye. Thank you so much. One of my professors will say that that why do you think that business is is a journey? It's not. You shouldn't go into business thinking you are going to win. And it sometimes bring up the issue of the United States going into Vietnam, and they going in with the mentality to win, while the Vietnamese were had the goal of sustaining the war, and that's why they couldn't go in there and win. Well, it's an argument that we can have later on regarding whether it's so or not. But it makes a lot of sense when you said that. You sort of stated that businesses, a business is a journey and not just a mile. So having said that, I wanted to
get. Kaidi, I just want to quickly clarify something.
Right.
So I said growing 7% week on week and 20x in a year. So not 7x week on week. That would be, I would even invest my money in that business. But 7% week on week and 20x in a year.
Thanks for clarifying that.
Thank you for the clarification.
Yes. So Gatumi, I also wanted to come back to you. So I wanted us to talk about investor and investee relationship. Where do we start, right? Where we want to raise money, fine. We've narrowed down to this set of people and so on and so forth. Where do we start? How do we negotiate with investors? Given that they have a lot of experience. I mean, investors, for you to be an investor, you have some experience to be able to be putting your money into an organization. When it comes to negotiation, how do you approach this, approach negotiation? How do you approach the organization itself? What documents are required and so on and so forth. I wanted us to get into that. Gatumi? Is Gatumi there?
Okay. Just make sure. Kaidi, can you hear me?
Yes, I can. Loud and clear.
Okay. Hear me now?
No.
Sorry, can anybody else hear me?
Okay, now I can hear you now. It's better now.
Okay, so I'll just do one more check, just so before I start talking. Can you hear me?
Yes, please. Yes.
Okay, excellent. Okay. So the question is a little broad because there's different stages from a startup or a smaller business. So I'm just going to approach it from let us say you are an early stage startup. I imagine that people are here at early stage startups. And one, are you able to raise a friends and family round? So let's say the answer to that is no. So the first thing is try and raise a friends and family round, right? Have your friends, your family, just like it says, give you small amounts of money, and you can evaluate at a safe. If you're able to raise, let's say, 20 million naira, right? You can use that money to get you to the next stage. It is often very difficult at the very, very early stage, if you're not a proven entrepreneur with, possibly an exit, to raise at the
We're losing you.
With a VC. So let's say you've been able to do that.
I think it's better now. Oh.
Okay. Can you hear me now?
Yes, I can. Go on, please.
Okay. All right. So sorry about this. Like I tried to explain earlier, I'm actually on my way to London, and I'm driving. So someone's driving me, so the network might go in and out a little bit. So like I was saying, so you've raised a bit of a friends and family round. You have some proven traction, and you're looking to raise your first your seed round. Let's talk about that. So I'm also assuming that you're a tech company or a tech-enabled company. So I always advocate for two things. Number one, if you can apply to Y Combinator, I'm a Y Combinator advocate, and this is why. Whether or not you get in, so let's say you don't get in, what YC does for you, it teaches you how to properly communicate your business to investors. Two, it tells you all the resources you need to position yourself for investment. For example, are you a Delaware C Corp, or are you, only listed in Nigeria, for example? Are you looking to build a global company, or are you looking to build a local company? Neither of them is wrong, but these are answers that you need to answer for yourself. These are questions, rather, you need to answer for yourself. And then three, it opens you up to a lot more investors. In talking to people, I realized that people think that there are only about, 20 or 30 VCs. There are thousands, and I literally mean thousands of VCs in the world who are looking to invest. And right now is the best time to be an African startup. Like Kaide mentioned earlier, yesterday, Flutterwave announced their 250 million at a $3 billion valuation. More and more VCs are looking to Africa to deploy capital because the developed markets are saturated. So, one, create a pitch deck. Have a solid pitch deck that is maximum 11 slides thick, right? So you need 10 slides, 11 slides. You need to state your problem, your solution, your team, unit economics, competitors, etc., 11 slides, done. And then build a small data room. Just a small data room, talking about your unit economics for the next 18 months, proof of use of funds, and just very minor things. Now, you get some investors that are asking you for EBITDA, profit, CBT, crazy things. In my opinion, stay away from them. You are a seed stage company. You don't know. You are looking for money to prove that your MVP that you developed with your friends and family money is scalable, and that more customers want that. So look globally. When we were doing our seed round, we had a sheet of about 400 VCs that, one, invested in Africa, two, invested in our type of business or a similar type of business, and send out an email to every single one of them. Now, if you're able to get one VC on board, it's a lot easier because they would then do introductions. Now, the trick is every VC wants you to get more funding, right? I think Amaka touched on this, because the more money you get, the more valuable their own share becomes. But there's a lot of opportunity in Nigeria, in Africa, and globally. Get a pitch deck, get a data room, and send out a cold email with your pitch deck. If possible, get somebody to introduce you. If not, send out that pitch deck to 400 different VCs, stating what you're doing, stating your traction. Remember, like I said, try and grow that 7% week on week. And most of the time, my bet is you will get 10% of people ask for more information, and then you can request a meeting. I think I'll stop there just to get a sense of where we're going, Heidi.
Thank you so much. I'm trying to also manage time. And I just remember that Amaka may not be staying for too long. She's a mother. She has to go pick her kids from school. If she doesn't, I will actually report her. So I'll let her speak. Amaka, could you speak to investor relations?
Okay, thank you. Absolutely happy to. Yeah, so effectively, all that Gatumi said, I'll say the key thing, right, is on, let's even start on how you get the funding. I think I see a lot of companies that don't have two things. The first thing I would say is get this MVP, like Gatumi said, which is your minimum viable product, right? So do something, do a proof of concept. Get your, bootstrap, right? Like find a way to put together funding to do your minimum viable, your just a viable product. Even if it's a tech solution, for example, and you don't even have the tech and you just done it, just do something to showcase that this is a viable business, there are companies interested, I'm solving a problem, and there are people who actually pay me money to solve this problem, right? So have that, I think, is the first thing I'm going to say. A lot of times you speak to some companies and they're like, this is an idea. And unfortunately, this is not Silicon Valley, right? In Silicon Valley, it's actually, you can actually raise with an idea. But here in Africa, typically, you would need a little bit more. Or you need to be like, a founder that has done a massive exit and everybody knows you and they're like, okay, fine, I'll get on board. But typically get a minimum viable product. Also, we look for founders that have made irreversible steps, right? So if you're a founder and you still have your day job, to be honest with you, I think it's very rare to find an investor that's going to say, I'm going to put my money in, but then you're hedging, right? So you can't hedge yourself, so you have to go all in. So once you have that, you've gone all in, you have a minimal viable product. You've shown that you've put in your savings in there, you really are dedicated to making this work. And then, yes, you put together your deck, and I think you then go out and pitch it, right? So I think the key thing is showcasing, one, the first thing is a team. Like, why are you uniquely placed or passionate or driven to solve that problem, right? Show that traction of what you've been able to do with the little you've had, because that is also like proof that you're going to take money and actually do more with it, right? And then I think the next step I would say is then, when it comes to, by the time you've written the check and, the venture capital fund has written the check and they're in business, it's sort of smooth sailing, right? It's easier because then it's really about formalizing the company, sitting on, having board meetings. You'll find yourself, once you get institutional money, you start to do, institutional things like actually have, quarterly board meetings that you talked about but probably don't do, right? So, or even more, like, we sometimes sit monthly meetings, right? They're not all board meetings, but have more frequent sort of check-ins with companies. I would say over communicate. I think it's always good for your investors to know where you are and what you're doing, and don't be quiet, don't be building and then there's no communication. I think it's always good to over communicate, share your milestones, your wins. Another thing I find also very important is, when you say what you're using the funds for, also have these core milestones that you're trying to get through, right? So these metrics that you're going to track for your company. When we say metrics, everyone quickly thinks of revenue. It's not just revenue, right? It's revenue, number of customers. So there's the typical business metrics, but then there are also like customer-oriented metrics, right? So let's think about how many of your businesses if you're a B2B company, for example, how many of these businesses you're working with are sticking with you month on month, right? Or how many are dropping off? Let's look at things like how many of your companies are you even, taking stock of what your companies are saying, the companies are saying about you, what your users are saying about you. Are they saying good things? Are they saying, I will recommend this company to to someone else, another user? So track those things. Track how much, like if you're doing a delivery service, like how many failed orders do you have? Like, what's the time it takes you to deliver? Track things that look at the quality of the service that you're producing. Another thing that's important, and it gets more and more important as you grow your business, is looking at what we call impact metrics, right? So look at the impact your business is having. How many, if you're doing something in health, let's look at things around like, how many people's, I mean, it's broad, but I've actually seen a company that tracks how many lives saved, right? And how many pints of blood they deliver, or how many, farmers you're working with, and how many have had, better income as a result of working with you. So track these impacts that you're having, number of people that have been employed because your company exists. Because truly, investors are getting more sophisticated with time and are realizing that it's not just about the numbers, right? It's also about the impact the companies are having. It's about the customer experience. And these are the things that actually lead to long-term growth in companies. So start tracking those metrics and start reporting them, both internally in your team and to your investors as well. So we've all gone into venture capital. I'll talk a little bit more about grants and debt, but I'll say for grants, right? It's very important when you're sort of positioning your company for grant funding to really look at that impact, right? So impact is also very key. So most people that are providing grants really want to know that there is some impact that will be gotten with the grant. So look at that. And then when it comes to debt, I mean, to be honest with you, by the time you're getting debt funding, you're a bit more advanced as a company. And we can talk into, I get a sense that most companies here are early stage companies, but what debt funders are looking for is very rigid, right? Typically very rigid and very detailed, right? In terms of the reports that you have to show. Then your EBITDA is important, right? Like they really want to know your cash flow, your audited accounts. So then it gets, a little bit more complicated. But I would say generally, start tracking metrics beyond the typical business metrics and keep reporting to internally, discussing them with your investors, as well as clear milestones that you're hitting, right? So when you hit milestones like, we now have, 5,000 businesses that we work with, mark those milestones and have that very clear. So these are some of the things I think you should track and also report when you're discussing with your investors as well.
Thank you. Yeah. Thank you so much, Amaka. Thank you. I appreciate it. Mr. Femi, I wanted to bring you in and also have you in terms of your own perspective of investor relation. In addition, I wanted to also bring in a question that a participant shared just now. The question says that how do investors verify revenue, because some early stage startups don't always have a great bookkeeping skills. Could you speak to that also?
Yeah, absolutely. Without data, you're probably not even in business. So why would you not have a revenue tracker or keeping record? So the first stage before you even start talking to any investors is to attend maybe hackathon or attend accelerator program, or find founding team that believe in the vision. So you can have other complementary skill set capable people to join your team. When I started out back then, I couldn't even afford money to pay for auditor to audit my 1 year financials, and I was already trying to talk to investors. This is just the starting point. So your record bookkeeping must be very up to date. So join those leagues that begin from the beginning to keep record. You don't need professionals to do that for you. There are a lot of software or application Excel sheet that you can download freely online to just keep those records. You can get someone close to you to just help you enter them, call them trial balance, ledgers, just to be able to have those records. And it's also important that you don't just make sales or collect income and spend it. So let them go through your bank account. It can even start with your own personal name bank account. I started with that. So when I was moving now into a more structured business, so I have to give all my personal bank account statement to my accountants for them to be able to extract out, so they can help you to write it. It's a journey, so you don't rush yourself up. But don't forget, today determines the future. So whatever the beauty of the future that you want to create, you must start today to make preparation for it. It's not tomorrow that creates today. So you must have that vision of where you are going, and you begin to put things in place like all other speakers have already spoken about, MVP. For you to be able to approach any serious investor, they want to understand how much connection do you have with the community that you're trying to solve a problem for. And I will always advocate also that it's not business plan that runs the business. It's actually the problem statement. So are you very clear about the problem that you want to solve? Are you connected? Are you clear about it? Do you understand how they are impacted? Who else is solving that problem? How are they solving the problem? Then your differentiation. So what makes you different from every other person? So innovation is not you just trying something new, but you can also innovate on what already exists. So by just taking it a little bit step forward, like Peter Thiel wrote about 0 to 1. So not just that you want to create something new entirely, but then you just want to add a little bit to improve, maybe to save more life, or maybe to reduce the man time, the time that it takes to achieve or accomplish a task. That could just be the reason why you are in that business. So keep your record, and of course, identify other skill set, other people that could bring complementary skill that you never have, like accounting, if you're an engineer like myself. So you also need people that could speak about your idea. So when I started up at some point, I got a friend from Canada that came in and said, Femi, you do so much, but no one knows about it. You have horrible websites. You can't even communicate what you do. You are just so lost in the bush trying to resolve issues with your micro entrepreneurs that no one is speaking about what you do. So when no one knows about what you do, how would they be able to assess you? I mean, fairly, because there are other people like we've also spoken about it today. You can take idea, a crude idea, pre-revenue, zero revenue. You see people doing SPAC, going IPO, pre-revenue. They don't even have any sales yet, but then they are valued $1 billion company. What is the difference? But you can't get that, make that happen in Africa or in Nigeria. So you need to, first of all, work on this small, think big, but as you're starting small, focus on proving yourself with just one prototype, at least. Then you can put that in a nice website, package it very well, and get communication team that could help you project this and begin to tell stories about it. And as you begin to tell stories, people that can connect with your vision will begin to reach out to you. And as you begin to get little traction in terms of revenue, then you will now see yourself having that pitch deck that you can take to begin to approach investors. And the other one that you asked again, Binga, sorry, which one?
That was the one about from Tosin. It says, how do investors verify revenue?
Verify revenue when you don't have.
Captured it already.
I've talked about that.
Yes, you captured it. Thank you.
Can I say something on the verification of revenue?
Amaka, I was actually going to ask you to say that, and also, give a closing. I mean, make your closing, because I know you are about to run off.
Yes, so sorry, on the verification, I think this is an important one. The first thing is, I would say to every business, like, start properly, right? So know the type of business you're building from day one. And it's just good practice. If you're building a business that you actually want to outgrow you and outlive you and to be this, a massive force for good, right? And a business that will actually scale, then start it properly. So on day one, set up a separate account for your business. Do not mix your business and, and personal accounts in any single way, shape, or form. Do set it up properly, get QuickBooks. I mean, right now, there's so many easy, very quick, cheap accounting platforms you can use for your business. It's really not that expensive. You don't even need to be an accountant. Plug those into your operations and make sure that, like, your business accounts are very clear, right? So do everything from your business account. in fact, I mean, good practice, you have several business accounts, right? Even as you have a business account, like so in your bank, you have one for these sort of payments, another for those sort of payments. So have your financial management really done down packed, because truly, one of the things, you know, a good sense, I mean, I've worked with several businesses, and really it's some of the biggest issues, like when you see a company that mixes things, typically these are the companies that fail. So make sure you set up from day one and set up your financial management and controls properly. That's the beginning thing. And even if you scale, I'll tell you, I mean, you can be a big microfinance bank, and I don't want to call names, or, you know, big companies, literally poor governance, poor financial controls. Even if you're $1 billion company, you will still at some point get caught, it will catch up with you, right? We've seen that with WeWork, we've seen that with several big companies. It always catches up with you. So just don't start properly, I think, on day one. On the question of how we do due diligence on companies, typically, obviously, let's assume you do have some accounts, so you do need to have some level of accounts, right? Not necessarily audited accounts, but fine, at least you know what you're spending, where money went, and things like that. Yes, it's a good guide to see that a company has the control. So we would do due diligence on companies to see that, fine, their controls put in place. But I tell you, I mean, due diligence process can be rigorous, right? I don't think I've ever put money in any business that I didn't speak to their customers to find out truly, like, I mean, it's okay to say like, yeah, I made this money, but I'm going to say, you know, who's your biggest customer? And I'm going to speak to at least the biggest customers, make it, and you verify on that end as well that truly, yes, these customers are, you know, they're actually paying you as much as you say they're paying you. And then, you know, I mean, I'm sure Gatumi has gone through this, right? So you will speak to your customers, who your biggest vendors are, your biggest partners. I mean, there's going to be a whole 360 review around you to make sure that what you're saying is really what, you know, what is actually happening, right? Because yeah, because I mean, you do have companies that are fudging numbers and doing a lot of stuff. I mean, there's a ton of different practices out there, but there's a huge due diligence process that goes into an investor putting in money. You might not find this as an angel round, which is why it's typically friends and family, so people who know you and trust you. But by the time you start getting institutional, trust me, you know, they will look through. So the banks are going to audit the accounts. If you're doing a debt on grants, typically there'll be an M&E specialist that is hired to go and look through to make sure what you're saying is true. But of course, typically when you have a large grant program, you can start getting away with some things. But on a venture capital deal, it's much rarer, right? So you would have a 360 review of the company. They would speak to your vendors. They would speak to your customers, and, you know, verify a lot of what you're saying with that, in addition to looking at your statements and just making sure they make sense, right? So these are some of the ways you sort of check that truly this makes sense. So if you say that you're making, you know, let's say you're making $100,000 or, you know, $1 million in revenue, I'm going to speak to your, you know, look through who's driving that revenue, and, you know, we'll speak to those companies and really check that, okay, truly, yes, you are a client of theirs and they are paying you, you know, similar amounts, and yes, okay, they're happy to do business with you, right? So there will be a due diligence process with every investment, and so that's also something that you have to be prepared to go through when you're taking in external money. So I think I'll just round up and say that really, thanks for having me in this session. I wish I could stay longer, but the key takeaways I want to say is that really, if you're looking to get funding for your business, I think very quickly you have to think through what you're looking to do at the very onset. So start very early to position yourself for financing. The first thing is have governance structures in place. So financial management is one of the big ones, right? So make sure your finances are done properly. Second thing is have as much traction as possible. So make sure that you, first of all, actually before that, you build your minimum viable product, right? Have something that you say, I've done a proof of concept. Don't just have a business idea in your head that you think would work. Go out, make revenue, show that truly this is something that is bankable. Have skin in the game. If you know, put 100% of your time and your energy into it, right? If you're truly committed, put your skin in the game. Once you're ready and you have as much traction as you can, then go out, put together a pitch deck, think through your business, right? So have that vision of what your business is, what problem you're solving. It's always fantastic if you can actually show a similar business that people know, right? So if you're a pay stack and you have in your pitch deck, which they did, right? You have a Stripe, and you talk about like you're going to be the Stripe of Africa, right? Then people get it because they get what Stripe is doing, and then they can sort of extrapolate to where you're growing, right? So make sure you have that vision, which tells people, the investors, this is the market, this is I'm looking to go into. These are the sort of companies I'm looking to be like. This is the strength of the problem, and this is the total value of the market. So make sure it's a big market, people are excited about it. It's a big problem you're solving, and then show them the team and how, why your team is uniquely placed to solve this problem, to execute on this, and how you're going to do this differently from your competition, right? If you think you have no competition, you probably don't know your business well enough. So once you're able to put that together, I think, like Gatumi says, properly network, come to events like this, go on LinkedIn, use your networks, ask for referrals. There are lists of VCs in Africa floating around. Do a ton of research and network your way into speaking to investors and getting your business funding. And if you want to do, if you want to start sequentially, I would say, look out for these incubator and accelerator programs. There's so many now, being sponsored by so many companies. There's Google, there's, go to as many events as you can, sign up for an accelerator program. If you get to the best, like Y Combinator, 500 startups, fantastic. If you can get to some of the Nigerian ones, just get into a structured program. It really does help you to think through and to position your business better. And it also is, these are also where a lot of investors are looking for, right? So typically, once you're a YC company, YC company, a 500 startups company, everyone is looking at you and thinking, okay, I'm interested to see what they're going to do next, right? So that also opens you up to a lot of investors as well. And it gives you some of the seed capital that you need to scale. So it's a win-win. So that's what I'll say in terms of my big nuggets.
Right.
Thank you again for having me. And
thank you so much.
Thank you.
As Amaka takes her leave, I will advise that all our participants begin to drop in their questions. Mr. Oye is still in the house and Gatumi is in the house. Before we go ahead, I would like to share a quick offer that we are sharing with you participants to help you through your journey of raising financing. So I'm sharing it right now. So we have a limited offer for 20 participants, a 30 minutes consultation with our deal advisory consultants. We will provide you with a list of 10 prospective funders for your industry. We'll provide you a one-page concept note template for introducing your company to prospective funders, and also a pitch deck template. It's for a small fee, subsidized. And then please feel free to contact the email, the phone number that is listed there. This offer lasts for just 48 hours. Doesn't include weekend. I'm sure you don't expect me not to sell anything. I will sell something. Okay, while that is on, are there any questions? I would like to take those questions now. Can we have questions? So while we are waiting questions, Mr. Oye, can I just ask you, so somebody's asking for the recording. We'll get back to you on that. So Mr. Oye, I wanted to ask you, from your own perspective, debt, equity, which would you, what are the pros and cons for debt and equity? What are the advantages and disadvantages?
Yeah, both debt equity are veritable strategies or tools that entrepreneurs will need at some point in time to growing your business. So to answer that question clearly, we need to first of all identify what type of industry and what type of problem you're solving. And you also need to define as well what stage is your business. So I've advised over the years that it's not all monies that you take. So there are tons of monies that we turn away or turn down. There are a lot of investors because 90% of investors that eventually comes on businesses, they offer zero value. Rather, I'm not looking for investors that will come to the boardroom or board meeting and begin to ask, why didn't you ship early? Why are customers not turning out? Why do you have this churn rate? But I'm looking for investors that would talk from the perspective of relationship, because investors, they are not just, you shouldn't look for investors that just want to throw money into your business and begin to wait at the end of the day that just want to get the return or the X that you want to create for them. So you need to also be careful at picking those type of investors that you want into your business, because it's a lifelong partnership. So debt or equity, when I started, from my story, I attend any possible accelerator program. Either they're going to offer me one thing or the other, I don't care. I just want to put in. So I joined some of those accelerator programs, which some people say they waste your time as a stage in your business. But the relationship, the friendship, the network, and the exposure that you get, the diversity that all these platform brings to you, you can't pay for that. You can't buy that. So when I even join the mailing list alone, that means I can get information, I can get insight, even when I don't need them anymore. I can get perspectives that could also help me or help any of our ventures to rethink our strategy. So that's why I encourage that just get in and participate in as much as possible. You are growing with it, you are expanding and getting more information to improving your offering. And of course, to redefine your strategies and your focus, reshaping it towards exactly where you're going. So when you're starting up, I warn that don't go for debt. Debt as a way of shrinking and killing you, because debt provider likely, they are not for startups. The debt is not for you to test idea. Debt is not for you when you are still struggling to grow. Debt is likely to catalyze, to expand and make you to grow exponentially. That is what you need debt for. Oops. Am I still in? Okay.
Yeah, you're still here. You're still here.
Yeah.
Yes.
So debt is for mid or later stage, or when you've been able to secure an equity, then you can use that equity. That is what we do. For every $1 million, we've invested over $100 million today in the last 10 years. So for every $1 million that we're able to close or to raise equity that we're able to close, we leverage it times 10. So that means for every $1 million equity or $100,000 equity, then you should be able to raise 1 million or 10 million debt for that to be able to be put into good use. And when you do anything less than that, then you are destroying the value of money. So for early stage, I encourage debt. For later stage, I encourage equity. For later stage, then you can begin to look at debt.
Okay, we are running very late at the moment, so I'm just going to try to manage the rest of the time. Gatumi, somebody asked the question, what is the percentage of debt equity mixture that you recommend? I would like you to respond to that question and also sort of give closing remarks for the businesses here. I'm sorry, time is very short. We have to manage in many 10 minutes. So Gatumi, over to you.
Okay, super. So first thing I'll say is I'm happy to connect with anybody on LinkedIn. So you can just find me by name. And if you have any further questions, I'll be happy to help. So if you're an early stage company, pre-seed, seed, and even Series A, typically take equity. The difference between equity and debt is this. When you take equity, you give up a small percentage of your company for money. That money never has to be paid back. It is yours because you have essentially sold parts of your company. Whereas with debt, that money is given to you with a promise to return the money with interest, but no part of your business is taken. So if you think about that, what you want to do at the very early stage, when you are proving your business, your idea, and your concept, take more equity. In fact, I would say take 100% of equity. Seed round, pre-seed, seed, and even Series A. When you start getting to your Series A, Series B, and down the line, you want to start to mix it, because now you want to sell less of your company and you're taking on debt because you have a proven model that will always generate revenue and hopefully profit. At that point, you can easily pay back your principal in the debt and your interest. As you go to latter rounds, and depending on your business model as well, trading company that's capital and reserve your equity for expansion, infrastructure, and maybe even salaries. So that's how I would answer that question.
Okay. Do you want to give your closing remark?
Am I good?
Yes, you're good. You want to give a closing remark?
Yes. Oh, my closing remark. Yes.
And in giving a closing remark, please. The young lady who asked the question also added a few more questions. She said, with equity, your percentage of ownership in the company keeps reducing. Is it safe?
Yes. So it is safe for your percentage of equity to keep reducing. Most $100 billion startups, for example, Airbnb, Dropbox, Uber, the owners only have low single digits ownership of their company. Here's how I would think about it. It's better to own 10% of a $100 billion company. That means you own 10 billion, than 50% of a $100 million company. That means you own 50 million. When you're thinking about growing a business, you want to think about growing a world-class business. Nobody owns up to 5-10% of, Barclays Bank, for example, Bank of America. You're thinking of at that scale. You don't want to be a local champion. You want to be a global, fighter, whatever the word is, right? So it is okay to own single digits if your company is valued in the tens to hundreds of billions of dollars. In my closing remark, here's what I would say. There's something that Y Combinator says. It says, one, build something that people want. Make something that people want. When you're building your company, remember why you started it. You were trying to solve somebody and hopefully millions of people's problems. You need to be able to clearly articulate this problem to your investor, and you need to be able to clearly articulate the solution to your investor. If you start with that basis and bring in people who are just as committed as you are to solving that problem, you are well on the way. And then once you're able to do that, build an MVP and get traction. Think about this: grow or die. If you're growing at, like I explained, 20x year on year, VCs will be the ones knocking at your door and telling you, hey, when you're ready to raise capital, I'm ready to give it to you. Please connect with me on LinkedIn. I'll be happy to connect with as many people as possible. Thank you.
Thank you so much, Gatumi. Mr. Femi, I wanted you to give your closing remarks and probably speak to any other, some of the questions I already asked. If you have any thoughts around that and any other thoughts you have.
Yeah, thank you so much. And I will also request you can follow me on LinkedIn as well. If you have any other follow-up questions, we've received quite a lot of insights, from the program today. And depending on why you are building, I just want to find out why is more important than trying to raise money, trying to do business, or trying to start up a new venture. So when you can define the why, it's going to be muddy, it's going to be tough. Raising finance is no joke. You need to get the right team, put the right team together. You don't want to be the entrepreneur entrepreneur and also the one knocking on investors' door forever. So you have to be everything as you're starting up, but as you begin to get grounded and you're grinding with the market, you need to begin to look out to hire the right talent or attract the right investors, the right advisors. And it's very, very important as my closing mark. Grow thoughtfully and surround yourself with quality advisors. So you can't build this alone. No one has been able to do it just alone. So when you've seen any unique company or anyone building something really, really amazing, they did not start by saying, I want to make money or I just want to build business. They started with a why. They wanted to solve problem. And when you're solving the problem, trying to solve the problem, ensure that the demographic and the size of the market is a minimum of 1 million people that you're solving that problem for. So when you're building a startup and you're still thinking below 100,000, below 500,000, so a couple of 10,000, then you are not building something that is great that would attract any investor. So you must build for at least 1 million users, 1 million community, 1 million customers. And as you do this, you surround yourself with the right type of people, then they will be the one knocking the door while you focus in doing the best that you can do to ensure that you brighten and you bring the flavor that goes along with that vision, because you are the one that has been given to, you are the one that can fine tune it, you are the one that can speak it better. So as you even want to build succession, it's because you've been able to create that systems that other people can continue after you have gone here. And that's how to build a business that lasts. So I encourage you to connect with me and we can take the conversation forward. Thank you for having me too, Kyle.
Thank you so very much. I hope that all the participants in the house this afternoon will agree with me that we've had an amazing, league of speakers this afternoon. And I want to give a round of applause for the trio of Mr. Femi Oye, Gatumi, and Amaka. Thank you so much for being here today. We truly appreciate you, and I'm sure that a lot of the folks on the call today also appreciate your time and your experience and your advice. Thank you so much. We've come to the end of today's session. Unfortunately, I wish we could still keep going on. I wish we could go up to about 3 hours, but it's not possible. A lot of people have other things they have to do. Please feel free to take advantage of our offer and reach out to that email and that phone number, and we'll be glad to assist you in getting you started on your journey. It's been an awesome time today. On behalf of my team, I have Ramat and William on the call assisting me with this. I really want to appreciate you guys. Thank you so much for making this happen. Yeah, so thank you so much. We'll look forward to the next session in March, and feel free to reach out to us. Let us know what topics you are interested in. Even from the polls today, we will take advantage of some of the numbers that we got from today's polls and use it to decide, what will be our next topic for March. All right, from here, my name is Kayode Ajayi Smith. I represent Smith's Work Limited, and it's bye for now. Thank you.